Most people lose money in Bitcoin for one simple reason. They trade with emotions. They wait to feel safe. They wait for confirmation. They wait for motivation. And when they finally enter the market, it's already too late. The market doesn't care how confident you feel. It doesn't care how smart you think you are. It only reacts to execution. This video is not about hype. It's not about price predictions or moon targets. It's about discipline, risk, and decision-making, because Bitcoin is at a critical point, and most people are completely unprepared. People like to believe motivation is what moves them forward, but motivation is temporary. Some days you have it, some days you don't. Discipline is different. Discipline doesn't ask how you feel. It doesn't negotiate. It executes a plan. In trading, discipline means knowing your entry, your exit, and your risk before you press the buy or sell button. If you're making decisions while you're already in the trade, you're late. The market doesn't reward excitement. It rewards consistency. One of the most dangerous things in crypto is self-deception. People start doing mental math. If I made this in 10 days, then in a month I'll make this much. If I just increase the size, I'll recover faster. If it worked once, it will keep working. That way of thinking destroys accounts. The market is not linear. It doesn't move in straight lines. It doesn't owe you continuity. Just because something worked recently doesn't mean it will keep working. And assuming it will is exactly why most retail traders lose money. They don't lose because Bitcoin is bad. They lose because they underestimate risk and overestimate control. Let's talk about money management, because this is where grown-up decisions are made. Don't put everything into Bitcoin. Don't put everything into the bank. And don't put everything into a single asset. Money sitting in a bank slowly loses purchasing power. Bitcoin, on the other hand, is volatile and unpredictable in the short term. The answer is not choosing one extreme. The answer is balance. The real goal is not becoming rich overnight. The real goal is improving your financial situation year after year, while staying in the game long enough to benefit from opportunities. Survival is the first strategy. Another mistake people make is confusing leverage with skill. Yes, leverage can increase profits, but it also increases mistakes. And most people don't survive those mistakes. If you don't have a clear reason for using leverage, you probably shouldn't be using it at all. Capital grows when risk is controlled, not when it's ignored. Professional traders don't look for excitement, they look for repeatable behavior. Now let's talk about Bitcoin itself. Bitcoin has reached a zone where context matters more than enthusiasm. Price alone doesn't tell the full story. Between $91,000 and $93,000, on the daily chart, Bitcoin is no longer a high-probability buying zone. That doesn't mean Bitcoin is finished. It doesn't mean the cycle is over. It means the risk-to-reward relationship has changed. Buying higher doesn't make you more confident. It just makes mistakes more expensive. Good timing doesn't guarantee profits. But bad timing almost guarantees losses. Many people buy because they're afraid of missing out. They don't want to be the one who missed the move. But markets punish fear. They punish impatience. And they reward preparation. If you missed an entry, that's fine. Another opportunity will come. Forcing a trade usually costs more than waiting. Before you enter any position, you must already know 3 things: where you enter, where you exit, and how much you are willing to lose. If those 3 things are not defined, you're not investing. You're gambling. Hope is not a strategy. Confidence is not a strategy. Discipline is. Bitcoin doesn't care about your opinions. It doesn't care about predictions. It doesn't care about narratives. It reacts to liquidity, structure, and behavior. That's why emotional traders get punished. And that's why consistent execution beats intelligence in the long run. This market can forgive technical mistakes. It can forgive being early or late. What it never forgives is improvisation. If you want to survive and grow in Bitcoin, stop trading how you feel and start executing what you've already decided. That's how you stay in the game. That's how capital is protected. And that's how real progress is made. Most people believe making money in the markets is about finding the next winning coin. The real problem is that almost no one asks when to buy, when not to buy, and most importantly, when to do nothing. And doing nothing is also a decision. In this video, we are going to talk clearly about what is happening in the market at the start of 2026. Which assets still have room to move, which ones are already out of timing, And why not everything that goes up is an opportunity? One of the most common mistakes traders make is confusing a bounce with a new trend. Yes, many assets are moving up right now, but rising prices don't automatically mean it's a good time to buy. When price reaches key moving averages, like the 55-period average, what usually follows is not endless continuation, but exhaustion. That doesn't mean the asset is dead. It means the risk to reward is no longer attractive. Buying high doesn't make you brave. It makes you exposed. Let's look at several altcoins people are watching closely. DOT, ADA, XRP, even Solana. They all show something similar. An upward bounce inside a broader structure that has not yet confirmed a strong long-term trend. That distinction matters. A bounce is something you trade short-term, not something you fall in love with. If you're entering late, you're simply taking the risk that others already took earlier. And in spot markets, when price is already extended, it often isn't worth it. On lower time frames like the 4-hour or 1-hour charts, what usually comes next after these moves is a flush of leveraged traders. Liquidations. The market needs to clear out late entries with oversized positions. So if someone is in futures and decides to take profits, that's reasonable. But forcing new entries at higher levels is usually a mistake. The market does not reward impatience. Now let's talk about something critical. Capital management. There is no money printing machine. Just because Solana is moving up doesn't mean you have to be in it. Just because XRP is rising doesn't mean you're obligated to participate. Capital is limited. Opportunities are endless. A trader's job is not to be everywhere. It's to stay alive, protect capital, and choose carefully. Ethereum is a great example of professional thinking. Many people obsess over whether ETFs will go up or down tomorrow. But when you truly understand the market, you realize something different. Well-defined sideways ranges can generate consistent income. If ETH moves within clear ranges for months, that's not boring. That's a reliable cash flow environment for those who know what they're doing. While some chase the big breakout, others quietly cover monthly expenses with consistency. That's financial maturity. Now, an important reality for 2026. Do not expect a classic alt season. We are not in a market where everything goes up without thinking. This is not a phase where even low-quality tokens rise by accident. What we are likely to see is selective rallies, specific assets, specific moments. Anyone buying everything and expecting the market to lift all boats will likely be disappointed. This is a market of selection, not mass euphoria. Bitcoin continues to set the pace. As long as Bitcoin maintains its structure, many cryptocurrencies will follow. But that does not mean all of them are good buys at any time. When price stays below key moving averages with negative slope, that is often not accumulation. It's preparation for further downside. And this applies to crypto and traditional markets. In regulated markets, unlike crypto, fundamentals matter. You cannot analyze stocks the same way you analyze Bitcoin. Companies, sectors, earnings, and macro context all play a role. Buying a stock just because it looks cheap is usually a mistake. The best entries often appear after weakness is confirmed, not before. Once again, patience becomes an advantage. Here's something important to understand. The market will not give you what you want. It will give you what it is willing to give. You can want millions, but the market only pays for proper execution, risk management, and time. Those who try to take more than the market offers usually end up giving profits back. For the first quarter of 2026, the focus should be clear. Trade structure, not hype. Avoid assets that are out of timing. Do not chase price. Protect capital. Think in terms of continuity, not lucky shots. Money is not made by being brilliant for one day. It's made by being consistent for years. If you made it this far, leave a like and subscribe. This year is not about rushing blindly into the market, but about moving forward with clarity, defined objectives, and disciplined decisions. Because in the markets, those who survive eventually win.